So let's get into it here. Northland Power, what they are, they're a globally diversified renewable power company. They're where they're really strong is really in the offshore wind business, particularly in Europe. But they are globally diversified. And they also have some natural gas element to them and regulated utility. But primarily renewable power. Symbol is NPI on the TSX. Trades at about $24. Market capitalization of $6 billion, and it pays what is an attractive yield right now of 5%. So looking at the company over the last 12 months, it's not been a good story for shareholders. Stock price has declined from over $44 to down to $24 in the last 12 months. And really, this has been the story for the company really over the last couple of years. Now, what we can see from this 5-year chart is that the stock price peaked around late 2021. And this was very typical of renewable stocks coming out of the pandemic. There was a big ramp up in a lot of industries. Renewables were one of them. Since then, it's been mostly down with some volatility, but not a good story over the past couple of years for investors. And this is previously a company that was widely considered to be one of the top renewable stocks. So let's see what's going on here. Is this just market sentiment? Is this actual stock movement based on financials? Well, here are the Q2 2023 financial results, and we can see big declines really across the board. So sales revenue was down 15% in the quarter, adjusted EBITDA down almost 31%. And then adjusted free cash flow per share, which is really the metric that we would look at to measure the profitability of the business, was down 64%. So few things were impacting the company. One was there were challenging market conditions in offshore wind, particularly. This has to do with pricing. I also believe it has to do with wind resource, which can be volatile. One of the big things that the company has also talked about recently were supply chain constraints, inflation, and higher interest rates. So the costs have been increasing. Costs to maintain existing assets, but perhaps more importantly, the cost to build new assets, because they are a very aggressive company when it comes to developing, and they have very aggressive growth plans to expand the renewable power portfolio. So all of these costs that they've budgeted for over the next couple of years have been increasing. There were regulatory changes in Spain, which resulted in deferred revenue, lower production there as well. And then as well, we're also comparing the company to 2022, where there was a spike in European market prices for power. And this, of course, had a lot to do with the invasion of Ukraine and the reduction in natural gas coming from Russia. Now, looking forward for the full year, the company has put out guidance. They still think that they're going to come in at the bottom end of their previous guidance range, which is for adjusted free cash flow of 170 to 190 per share. And then, so assuming they come in at that $1.70 in free cash flow per share, that would be about a 13% decline in free cash flow compared to 2022. Now, the valuation right now is well below the historic average. Right now, trading at about 14 times cash flow. So this is quite cheap for Northland Power compared to where it's been over the past several years. As I'd said, the company does have a very aggressive plan for developing new assets in its portfolio, and what they're looking to do is expand their production, more than double it by 2027, their production capacity compared to 2022. So growing from 3 gigawatts of capacity in 2022 to about 6.5 gigawatts in 2027. And then they see opportunities to expand well beyond that, up to 12 plus gigawatts over future years. And of course, this is going to result likely in very strong EBITDA growth. But 1.2 to 1.3 billion in EBITDA is what is expected in 2023. They're looking at growing this at about a 7 to 10% compound annual growth rate to 1.7 to 1.9 billion by 2027. And then they think they can get over 3 billion by 2030. So aggressive plans for growth. But one of the caveats here is that the company's historical track record has not been great in terms of just consistent growth year over year, which is, of course, what we like to see. And this has really also showed up in the per share growth rates of free cash flow. So adjusted EBITDA really has moved up and down. I mean, the trend has been for growth over the past 5 years, but there's been some volatility. And then adjusted free cash flow per share really hasn't gone anywhere from the 2019 to 2020 level. Actually, we're looking at about 170 per share for the current year, which is going to be the lowest level of free cash flow per share that they produced over the previous 4 or 5 years. So one of the things that we do look at in a company is we like to see a consistent track record of growth. Doesn't have to be perfectly consistent, but we want to see that trend of year over year growth over a period of time. And we want to ensure that the company is growing their per share earnings or their per share free cash flow. So one of the things that we've always noted from watching Northland is that they don't seem very focused on the per share growth. They have very aggressive strategy for expanding the portfolio. So that's going to lead to higher sales. That's going to lead to higher EBITDA. Does not necessarily lead to higher free cash flow per share, which is really what we're looking for. So our take on Northland Power, there's a few things we really like about the company. Certainly, it's a globally diversified renewable power stock, one of the best in the business. They do have that aggressive expansion strategy, which has the potential to produce a lot of growth. And then the valuation is quite cheap relative to the historic range. So 14 times free cash flow, if we had confidence that free cash flow per share wasn't going to continue to decline, would be what we consider a very attractive valuation for a company like Northland, given the industry that it operates in and the geographic diversification. Now, the trend has been for lower free cash flow per share, and that's an issue. But, when we look at this company historically, one of the issues we've had with it in the past is that it's always been what we consider expensive relative to free cash flow, upwards about 30 times. So that valuation has been cut in half. Now, on the negative side, financial performance in recent years has not been great. They've really kind of trended in a range. Free cash flow per share, as I said, has actually trended down slightly, expected to continue to do so in 2023. There's a lot of cost pressures on the business right now with higher interest rates. They have a fairly leveraged balance sheet, so interest expense is a concern. Cost pressures on their development projects that completely changes the economics of the business. And there's also been that lack of focus historically on growth in per share free cash flow or per share dividends, which we're always looking at a company relative to how they can grow on a per share basis, since that's what you own as a shareholder. You own shares. So the company is high on our monitor list. I don't want to, underestimate its ability to grow and provide shareholder returns over the next 5 years. It is not a current recommendation based on the points that I made. And what, of course, we'd be looking for is just, we want to see consistency of growth in free cash flow per share. And hopefully that's going to lead to dividend increases eventually as well. Now, given where the valuation is, given that they do have high quality long-term assets, some investors could potentially take a small position due to low valuation, but I would not consider this a core company to own right now. I consider this a company to monitor very closely. And when the time is right and it hits some of the targets we're looking for, we could potentially upgrade it to a recommendation.
I think it's a good summary. I think what you hit on there is the company not always delivering on their targets is kind of really what keeps you on the sidelines to some degree, is it not?
It is, yeah.
A history of watching the company kind of overpromise and underperform.
I don't know if it's much as that they've been over promising, but they have been underperforming. I would say my expectations on the per share growth is really what it comes to. Yeah.
Yeah. And you'd like to see more per share growth to really be an investor at this stage.
Yeah, consistency. Even if you're just talking, 5% per year, but you want it on that free cash flow per share line. Understandably, as I said, with the cost pressures, that might be hard to do right now. Some other macroeconomic factors as well. But this is, every once in a while, a company can have a bad quarter, a bad year. But, we really haven't seen that consistency of growth that we want to see.
Yeah. And we do have like another renewable power producer that now is producing significant per share cash flow growth. And that, we're recommending that above it essentially at this point.